In the dynamic world of finance, businesses face crucial decisions daily. These decisions shape their growth trajectory and determine their success. Two fundamental concepts lie at the heart of these financial choices: cost of capital and capital structure. Understanding these concepts is paramount for any business aiming to thrive in the competitive market. Cost of capital represents the return a company needs to earn on its investments to satisfy its investors. It is the average rate of return required by both debt and equity holders who provide capital to the company. Capital structure, on the other hand, refers to the mix of debt and equity a company uses to finance its operations and growth. The interplay between cost of capital and capital structure is undeniable. A company's capital structure directly influences its cost of capital. A higher proportion of debt, while potentially amplifying returns, also increases the company's financial risk. This in turn leads to a higher cost of capital. Therefore, striking an optimal balance between debt and equity is essential for maximizing shareholder value. This introductory exploration sets the stage for a deeper dive into the intricacies of cost of capital and capital structure. Understanding these concepts empowers businesses to make informed financial decisions, ensuring sustainable growth and profitability. The cost of capital serves as a critical benchmark in corporate finance. It guides businesses in evaluating potential investments and making strategic decisions that impact their financial health. A clear understanding of this concept is essential for maximizing shareholder value. One of the primary roles of the cost of capital is in capital budgeting decisions. When a company contemplates investing in a new project, it needs to assess whether the potential returns from that project exceed the cost of capital. If the expected return falls short, pursuing the project would be financially unwise. Furthermore, the cost of capital plays a pivotal role in shaping a company's capital structure. Businesses strive to minimize their cost of capital to enhance profitability. By carefully balancing debt and equity, companies can optimize their capital structure to achieve the lowest possible cost of capital. The cost of capital also serves as a measuring stick for a company's overall performance. Investors and analysts closely scrutinize a company's cost of capital to gauge its effectiveness in utilizing capital and generating returns. A lower cost of capital often signals strong financial management and efficient operations. In conclusion, the cost of capital is not merely an academic concept, but a practical tool that permeates various aspects of financial decision-making. From investment appraisal to capital structure optimization and performance evaluation, the cost of capital plays a central role in shaping a company's financial strategy and ultimately its success. The cost of equity represents the return required by investors who provide equity capital to a company. It reflects the opportunity cost of investing in that particular company's stock rather than investing in other available investment opportunities with similar risk profiles. Two widely used methods for determining the cost of equity are the Capital Asset Pricing Model, CAPM, and the Dividend Valuation Model. CAPM, a cornerstone of modern finance, provides a systematic approach to calculating the cost of equity. It starts with a risk-free rate of return, which represents the return an investor can earn from a risk-free investment, such as government bonds. To this, CAPM adds a risk premium which compensates investors for the additional risk associated with investing in the company's stock. The risk premium is determined by multiplying the market risk premium, the difference between the expected return on the market portfolio and the risk-free rate, by the company's beta. Beta measures the stock's volatility relative to the overall market. A beta greater than 1 indicates higher volatility than the market, while a beta less than 1 suggests lower volatility. The Dividend Valuation Model, on the other hand, uses the expected future dividends and the current stock price to calculate the cost of equity. It assumes that the value of a stock is equal to the present value of all future dividends it is expected to pay. This model calculates the cost of equity by finding the discount rate that equates the present value of future dividends to the current stock price. Both CAPM and the Dividend Valuation Model offer valuable approaches to estimating the cost of equity. However, it's important to note that each model has its limitations and relies on certain assumptions. The cost of debt represents the interest rate a company pays on its debt financing. It reflects the cost of borrowing money from lenders or bondholders. Understanding the cost of debt is crucial for businesses as it directly impacts their overall cost of capital. Debt comes in various forms, with irredeemable and redeemable debt being two common types. Irredeemable debt, also known as perpetual debt, refers to debt securities that have no maturity date. These bonds pay interest indefinitely and the principal amount is never repaid. The cost of irredeemable debt is relatively straightforward to calculate. It is simply the annual interest payment divided by the market value of the debt. Redeemable debt, on the other hand, has a fixed maturity date when the principal amount must be repaid. The cost of redeemable debt is slightly more complex to calculate as it takes into account both the interest payments and the repayment of the principal at maturity. The yield to maturity, YTM, is often used to determine the cost of redeemable debt. YTM represents the annual rate of return an investor can expect to receive if they hold the bond until maturity. It considers the current market price of the bond, the par value, the coupon rate, and the time to maturity. In addition to the type of debt, several other factors can influence a company's cost of debt. These include the company's creditworthiness, prevailing interest rates in the market, and the term of the debt. Companies with strong credit ratings typically enjoy lower borrowing costs, while riskier borrowers may face higher interest rates. Section 5. Weighted Average Cost of Capital, WACC, a balancing act. The weighted average cost of capital, or WACC, represents the average rate of return a company must earn on its investments to satisfy all its investors, both debt holders and equity holders. It reflects the overall cost of capital for a company considering its specific capital structure. Calculating the WACC involves weighting the cost of each source of capital by its proportionate representation in the company's capital structure. The formula for WACC is as follows. WACC equals E divided by V times RE plus D divided by V times RD times 1 minus TC, where E is the market value of equity, D is the market value of debt, V is the total value of the company, which is E plus D, RE is the cost of equity, RD is the cost of debt, and TC is the corporate tax rate. The WACC calculation highlights the importance of each source of capital's relative weight in the company's financing mix. If a company relies heavily on debt financing, its WACC will be influenced more by the cost of debt. Conversely, if equity financing dominates, the cost of equity will have a greater impact on the WACC. The WACC serves as a crucial benchmark for evaluating investment opportunities. Companies use their WACC as a discount rate in discounted cash flow analysis to determine the present value of future cash flows generated by potential projects. In essence, the WACC represents the minimum rate of return a company needs to earn on its investments to create value for its investors. By understanding and effectively utilizing the WACC, businesses can make informed investment decisions that lead to sustainable growth and profitability. Section 6. Capital Structure, striking the right balance. Capital structure refers to the way a company finances its assets and operations through a combination of debt and equity. It represents the proportion of debt and equity used to fund the company's investments and growth. Determining the optimal capital structure is a critical decision for any business, as it directly impacts the company's risk profile and profitability. The goal of capital structure decisions is to find the right balance between debt and equity that minimizes the cost of capital and maximizes shareholder value. However, there is no one-size-fits-all approach to capital structure. The optimal mix of debt and equity varies depending on several factors, including the company's industry, business risk, growth prospects, and market conditions. Debt financing offers several advantages. Interest payments on debt are tax-deductible, which reduces the effective cost of debt. Additionally, debt financing allows companies to leverage their equity, potentially amplifying returns for shareholders. However, excessive debt can increase financial risk and make the company vulnerable to financial distress, especially during economic downturns. Equity financing, on the other hand, provides more financial flexibility as there are no mandatory interest payments. It also does not increase the company's financial leverage. However, equity financing can dilute existing shareholders' ownership and control. Finding the right balance between debt and equity is a dynamic process that requires careful consideration of various factors. Companies need to assess their risk, tolerance, growth plans, and the cost and availability of both debt and equity financing options. Section 7. Factors influencing capital structure: a multifaceted landscape. Determining the optimal capital structure for a company is a complex process influenced by a multitude of factors. These factors can be broadly categorized into internal and external factors, each playing a significant role in shaping the company's financing decisions. Internal factors relate to the company's specific characteristics and operating environment. Business risk is a key internal factor. Companies operating in volatile industries with unpredictable cash flows might opt for lower debt levels to mitigate financial distress during downturns. Financial gearing, which refers to the proportion of debt in a company's capital structure, also plays a crucial role. Higher gearing amplifies both profits and losses, making the company more sensitive to interest rate fluctuations. Operating gearing, on the other hand, relates to the proportion of fixed costs in a company's cost structure. Companies with high operating leverage might prefer lower debt levels, as fixed costs add to their financial obligations. External factors such as macroeconomic conditions and market sentiment also influence capital structure decisions. Prevailing interest rates impact the cost of debt financing. Low interest rates often encourage companies to take on more debt, while high rates might lead to a preference for equity financing. Market conditions also play a significant role. During economic booms and bull markets, companies might find it easier and cheaper to raise equity capital, leading to a preference for equity financing. Conversely, during recessions or bear markets, debt financing might be more accessible or appealing. In conclusion, capital structure decisions are not made in isolation. They are influenced by a complex interplay of internal and external factors. Companies need to carefully analyze these factors, assess their risk tolerance, and choose a capital structure that aligns with their overall financial strategy and business objectives. Section 8. Traditional approach versus Modigliani-Miller theorem. Two sides of the coin. The relationship between capital structure and the cost of capital has been a subject of much debate in the field of finance. Two prominent schools of thought have emerged: the traditional approach and the Modigliani-Miller theorem. The traditional approach argues that a company can reduce its overall cost of capital and increase its value by incorporating an optimal level of debt into its capital structure. This approach suggests that debt financing is initially cheaper than equity financing due to the tax deductibility of interest payments and the lower risk perceived by lenders. However, the traditional approach also acknowledges that as a company increases its debt levels, the cost of both debt and equity will eventually rise. This is because higher debt levels increase the risk of financial distress, leading lenders to demand higher interest rates and investors to require higher returns on equity. The Modigliani-Miller theorem, on the other hand, posits that in a perfect market with no taxes, bankruptcy costs, or other market imperfections, the value of a company is independent of its capital structure. This implies that the cost of capital remains constant regardless of the mix of debt and equity financing. The Modigliani-Miller theorem argues that any benefits from using cheaper debt financing are offset by the increased cost of equity due to the higher financial risk. This theory revolutionized corporate finance by challenging the traditional view and highlighting the importance of market imperfections in shaping capital structure decisions. While the Modigliani-Miller theorem provides a valuable theoretical framework, it's important to note that it relies on several unrealistic assumptions, such as the absence of taxes and bankruptcy costs. In the real world, these imperfections do exist and can significantly impact a company's capital structure decisions. Section 9. Real-world applications. Putting theory into practice. The concepts of cost of capital and capital structure are not just theoretical constructs, they have tangible applications in the real world. Companies across industries utilize these concepts to make informed financial decisions that drive their success. One prominent example is the technology giant Apple Inc. Known for its innovative products and strong financial performance, Apple maintains a relatively low debt-to-equity ratio, reflecting its strong cash flow generation and preference for financial flexibility. This approach allows Apple to invest heavily in research and development and pursue strategic acquisitions without being burdened by high debt obligations. In contrast, the telecommunications giant AT&T operates in a capital-intensive industry with significant infrastructure investments. As a result, AT&T carries a substantially higher debt-to-equity ratio compared to Apple. This reflects the company's need for large sums of capital to fund its network expansion and technology upgrades. These examples demonstrate that there is no one-size-fits-all approach to capital structure. The optimal mix of debt and equity varies depending on the company's industry, business model, growth prospects, and risk appetite. By carefully analyzing these factors and applying the principles of cost of capital and capital structure, companies can make strategic financial decisions that maximize shareholder value. In conclusion, the concepts of cost of capital and capital structure are essential tools for financial decision-making. By understanding these concepts and their real-world applications, businesses can optimize their financing mix, evaluate investment opportunities effectively, and navigate the complexities of the financial landscape to achieve sustainable growth and profitability.